The Money Show.
Personal Finance with Warren Ingram.
I look forward to weekends. I love weekdays. I love my job. It's wonderful. I get to speak to fascinating and wonderful people. But this weekend in particular, I'm looking forward to more than most other weekends because I get to, in public, put Warren Ingram on a pedestal and torture him. It's going to be so much fun. Because your book is at the Franschhoek Literary Festival this weekend, Warren, your global investing book. And I'm thoroughly looking forward to talking to you at 1 o'clock in Franschhoek at the Literary Festival. And I think we're going to have a very engaging conversation about global investing.
I'm looking forward to it, Bruce. 1 o'clock on Saturday, to be clear, but I was tempted to kind of have some comments before the time, just to make sure you don't rattle me. But looking forward to it.
I'm preparing my rattles. Now listen, let's rattle tonight on the issue of volatile investment markets. Share prices going up, share prices going down. We hit a record level of about 77,000 on the all-share index not so long ago. We're down at 67,000 on the all-share index, which is a sharp pullback. I mean, it was a sharp rise and a sharp pullback. And for many investors, this sort of volatility is fairly miserable. You feel super rich one day and you think, oh, everything's going right. Look at me, I'm a genius. And a month later, you're thinking, this is the end of the world. I really need to make another plan. Otherwise, I'm going to starve. So how do we ensure that we can sleep at night when it comes to the massive volatility that we're having to endure?
Yeah, and I think just to add to that, the other asset type which is struggling with volatility is the bond market. Both in South Africa and overseas. And just to explain that, when interest rates are rising, and especially when investors anticipate that interest rates are going to rise, the prices of bonds start to fall, and that's what we're seeing at the moment. So it's all good and well that you're going to earn more interest on your cash, and even your bonds in the future might actually give you a lot more interest. The problem in the short term is your kind of stable asset, which is what bonds are supposed to be in a portfolio. Those are the ones that are also giving volatility at a time when you're looking for something to offset the volatility of stock markets. So it is a tricky time, Bruce. And I think the first comment, and it's so boring, but it's true, is stay calm. This too shall pass. Don't panic. Don't make big radical calls when you own sort of quality assets. I think the temptation now, and the kind of interesting questions to hear from investors are, shouldn't we just move to cash now? Interest rates are going up. We're going to get a bit more of a return on our cash. Let's just park the money in cash and wait for all this stuff to pass. And once it's all settled down and we know what inflation is going to do, we know whatever happens in the Ukraine gets sorted out. Isn't it then a good time to start buying assets again and buy the bonds and buy shares? And it'll all be in the past. And I think intuitively it's an argument I always understand. I think it's a nice one, especially for people that live off their assets, that are getting an income from their assets. But unfortunately, the opportunities for owning quality assets and especially buying quality assets at a good price don't present themselves when everything is going well and all the troubles are behind us. In fact, the best opportunities are when the troubles are landing in your lap, like a thunderstorm. And I feel that's where we are now. So it's not the time to run away, unfortunately. And if you are trying to get growth on your investments in the future, then understanding that these kinds of times, when everything's going up and down the whole time, and people like me talk about volatility nonstop, that is the time when you should be saying, this is normal. This is part and parcel of being in markets, and inflation is a concern that investors have had for many decades. It's something that we get used to and we will adapt to. War is not something we're supposed to get used to, but it will come and work its way through the system eventually. And sitting in cash is just going to be a really terrible idea over time. So step one, please don't panic.
And just take step number one is don't panic. And if you need to step 1B, cast your mind back to March, April of 2020, where if you had panicked in that short, sharp shock that markets hit markets, and lots of people did panic. They're just like, oh my goodness me, we're down 10, 30, 20, 30, 40%. Let's run. by the time you woke up a month later, markets had surpassed their previous levels because suddenly it was believed that COVID could be, to a large extent, corralled and controlled and we would actually survive the crisis. This wasn't the end of the world.
It wasn't, and I think the reason why markets fall is always going to be different, but that they follow a pattern and sort of a similar theme, I think that's true. And this time around, it will be a little bit different because the concern is not kind of a shock from the side, which is a pandemic that that hits most people for the first time in their lifetime. This time around, it's a concern about inflation causing reserve banks around the world to raise interest rates. And if inflation keeps going and reserve banks have to keep pushing up interest rates, eventually it pushes global economies into a recession. So it's a valid concern. And I think that because inflation takes time to unfold, this is probably with us for at least the remainder of this year. This kind of volatility. So step two or kind of comment two here is if you haven't panicked now, please don't panic in 3 or 4 or 5 months' time when the situation is not much better than where it is today. The concerns are there, but once investors look through this, once they start to feel like they've got a grip on what inflation will do, and especially then what central banks will do, then they'll start to price their assets better, and we will see a recovery in markets because that's what markets do eventually. And I feel the opportunities to buy are presenting themselves now. So I guess step three then is be careful that you don't kind of skew your whole mix of assets. In other words, don't be totally invested in a dead asset like cash, which is giving you no return but no volatility. Similarly, don't be 100% in shares with no cash to deploy if you then want to take advantage of some opportunities. And then for a lot of us, we've been looking at these international markets and saying for quite some time, we wouldn't want to own international bonds because, the only way that they can go in terms of price is down because at some point interest rates need to rise. Well, interest rates are rising and very soon there will be a time when it's time to start adding international bonds to your portfolio. And I think in South Africa, the same for people that are looking for income. Getting 10 or 11% a year on government bonds in South Africa is nothing to be sneezed at. I think it is a good return, and it's a very nice complement to shares, even though the bonds are really volatile now. So I think my other big comment there is make sure that your mix of assets is right. Make sure you've got a good spread of assets across cash, bonds, and shares. And at some point, we'll add property companies back to that conversation. I think we need to see what the economy does in South Africa first for that to happen. But certainly internationally, global property companies need to start being considered again. So I think it's also about then just getting the mix right. Once you stop panicking and once you realize that this situation is going to be with us for quite some time. And then maybe the other big comment is don't get sucked into the negativity. Don't get sucked into the doomsday scenarios. I'm reading quite a few articles, globally where people are sort of forecasting, that we see no returns for the next decade. This is going to be a lost decade like we saw at the start of the year 2000. And that might come true. Even a broken clock is right twice a day. But I'm not convinced that you need to buy those arguments simply because they're well made. Someone can make a really intelligent sounding argument that's completely wrong. And the reality is markets deliver returns for most people in periods of 5 years and more. And there's no reason that we wouldn't expect the same, especially from the JSE. I think the JSE is going to represent a fantastic market opportunity for a lot of investors if they stay patient.
That's an incredibly brave thing to say, Warren, particularly when people are hurtful, and that's, I think, a legal word, when it comes to Eskom and corruption and all of the stuff that is shoved down our throats each and every single day. People are just exhausted of the pervading narratives. And it's that ability to see through those pervading narratives that will help you better inform your decision-making process.
Yeah, and I think it's let's acknowledge the sentiment and I think we're a brilliant country for kind of explaining in detail our problems and the things that are going wrong. We're very good at that. All of us are armchair experts, but we're not that good at any kind of positive signs, any kind of turnaround. Whether it be in philosophy, implementation, reform, all of those things. So there is good news happening. But just to park it for a second and just look at the JSE itself. The reason why I make that comment with some confidence is the JSE itself is not a price of the South African economy. The biggest company in the JSE from a top 40 index point of view is Richemont. It's a company that sells luxury goods around the world and especially kind of more and more in the developing world than everywhere else. And then you add the mining houses and you add the Naspers and the like. And what you realize very quickly is that the biggest majority of revenue generated by the top 40 shares on the JSE are not generated in South Africa. So me making the comment that the JSE represents good value is not the same as saying invest all your money in South Africa specific companies and you're going to do incredibly well. That might still be the case, Bruce. I think it's worth talking about. But the JSE itself, it's not a price of the South African economy. It's more of an emerging market, especially more Asian emerging market index. And it will develop, kind of give us good returns once the noise is settled through the world system and inflation is being kind of handled. So that's the reason for that comment. But I think we are seeing some reforms in South Africa. Yes, they're too slow. Yes, they could always be better. And I'm saying that while I'm kind of living on load shedding on my UPS at my house while I'm talking to you. But we will get through this. And once we're through it, the companies that are surviving today are really the survival of the fittest, the best management teams, the best operators that have dealt with so much, far more than most countries could ever deal with, and they're still standing. And those are the ones that will be generating fantastic profits when they get any kind of assistance from economic growth.
Let's get to questions. And talk about Roberta's question. Now, I got an email today from Roberta. He's a regular correspondent with The Money Show. And he was saying Warren Buffett is known for saying that you should look at a company 10 years into the future. We're looking 10 years into the future for Naspers. One would think their investments globally would grow and become a larger proportion of the business than Tencent. So my question to Warren is, does he see a potential future for Naspers in 10 years' time where the share price has grown to 10,000 Rand? If so, is this not the buy of the decade? Well, if it is, it would be. I'm not sure if you're going to put a price on it right now, Warren, but certainly the rationale of, progress and growth and opportunity is sound.
You're right. I'm not going to put a price on it because that's the only guarantee I'll give you is that whatever my price prediction is, it'll be perfectly wrong, even if it's sort of right. So let's talk it through. I think it's a very nice example of what I'm talking about. The share price has been absolutely hammered. They've had to write off hundreds and hundreds of millions of rands worth of assets because of their Russian interests. So they've had to write it to zero because of the sanctions, which they've done. Then their Chinese operations get hammered by regulators in China. And if you listen to fund managers who are based in places like Singapore, I remember listening to forward fund managers talking about this, and they're saying that both us in South Africa and the Western fund management industry simply don't understand what the Chinese regulators are doing. They believe that big tech in China has become so big that it's become anti-competitive. That is exactly the argument that the regulators are saying for big tech in the States and in Europe. And in fact, regulators are fining big tech in Europe already with the biggest fines in history. So what's happening in China is that the regulatory environment changes very quickly with very little consultation to solve a problem. And we have to acknowledge that when something is too big and becomes monopolistic, it can become an economic detriment. And I think that's the argument for why the Chinese regulators are moving so quickly. So yes, there's not a lot of consultation. We don't all feel warm and fuzzy about it. But once that regulation is fixed, and once the problems as they see them are resolved, that doesn't destroy the case for big tech in China. It just means it creates opportunities for more competition. And some of these businesses are very global. They are great capital allocators. They've got a huge head start on a lot of their competition around the world. And I would be really surprised to see, if we don't see big Chinese companies kind of moving into the world, provided we don't get more wars and that kind of stuff, and become very dominant players across much of the rest of the world. So I think there's a very good argument for buying, especially Prosus in the story, because that's the more direct listing into those global investments, and I think that an element of optimism there is sound. But again, please don't go and make that sort of 20 or 30% of your portfolio. When you allocate shares, like Buffett says, for 10 years, that's a good call. But don't go and kind of bet your whole house on it, because we could all be completely wrong, and then something unforeseen happens and destroys those companies. I don't see it. But you have to have a good spread of shares when you're going to buy individual shares.
And then another question from Stanley. Now, Stanley says, Dave Ramsey. Dave Ramsey is one of these religious guys in the US, and he sort of combines religion and personal finance, and he's incredibly popular, incredibly popular in the United States. And lots of people in South Africa like him too. A renowned American financial advisor and author. Recently, I came across a social media post about his 7 baby steps program to get out of debt and build wealth. Please see attached. I didn't have time. I hope you did. What do you think of the sound step, and whether or not it's applicable in the South African context? I'm sure it's perfectly in order and perfectly sensible. I like this idea of a baby steps program to get yourself out of shtuk.
Yeah, I must say I did have a look, and I do like it. So I'll speed through it and then just adapt it for South Africa. The first thing he says is save $1,000 for your starter emergency fund. And so in the South African context, I think for people that haven't got any kind of emergency fund, if you can give yourself the goal of getting to the point where you have at least sort of 10,000 Rand sitting in an emergency fund that's there to help you stay out of debt when you get a nasty financial shock, I think that it is a smart call. And then his second step is pay off all debt except your house, and then use the debt, using the debt snowball. In other words, start by paying off your most expensive debt. Let's say it's credit card first, and then whatever money you were using to pay off the credit card, you use that to pay off the next most expensive debt. And so you keep raising cash from all the debts that you've been paying off to pay off more and more debt as fast as you possibly can. So once you've paid off all of your debts, and he's talking about personal loans, overdrafts, car debt, once you've got that out of your life, then build up a proper emergency fund, which is 3 to 6 months worth of your normal expenses, and that should just be sitting in a money market account, something that you can access when the wheels have fallen off and you need to pay for something unforeseen, and you don't need to then go into credit card debt again. So his next step after that is save about 15% of the income that your household generates, and that's for your long-term capital. That's for your long-term retirement savings. And South Africa, I think that's something we talk about a lot. Except that people that want to get to financial freedom a bit faster, I would suggest maybe not 15% as your base case, but maybe a little bit higher. So somewhere between 15 and 25%. If you can't do that straight away, just start. Start by saving 5%. And then next year build it up to 7% and keep going. But don't just say, well, I can't get to 15%. I'm not even going to try. That really doesn't make sense. You've got to give yourself small goals and take the baby steps to get to that 15% goal, then the 20% goal, and carry on. Then Ramsey's fifth step is save for your children's university fund. I think that's a good call. And then his second last step is pay off your home loan early. Again, that's absolutely applicable in South Africa as well. And then his last step, and I guess that goes to his kind of social bent as well, is build wealth and then give, and do your philanthropy. And I think, in South Africa, lots of people are giving all the time. We have family responsibility. Most of us, parents, siblings, children, and the like. So I think we probably do that in South Africa already. But those are his 7 steps, and I think they are really applicable for South Africa. I'm not sure that they're all baby steps, but for me, it's a great way to go.
Wonderful. Then a phrase of the week. I've never heard of this. A stop loss order. What is that?
So it's something that people who have been who've been buying cryptocurrencies for the last few years would love to have put in their portfolios. So what happens is if you trade individual shares or you trade individual investments, when you buy the investment, let's just say you pay 20 Rand for it. That's your purchase price. What you can do on most trading systems is you can say that if that price falls by, just for argument's sake, 10%, you must immediately and automatically sell it. So if you've paid 20 Rand and it loses 2 Rand, which is then 10%, it must automatically sell. So you don't need to put in a new instruction or sit there monitoring your shares or your other investments all the time. You can just have these automated stop losses that kick in and then limit your losses by to whatever level you want. The 10% example for me is just an illustration. It could be anything. You could say 5% or 50%. So it's something that most of the kind of stockbroking platforms around the world will have. So South Africa stockbrokers will be the same. And then, the more sophisticated platforms where you can buy all sorts of weird and wonderful exotic instruments will often have the same investment strategy. For traders who are really active, they will often put these kinds of stop loss orders in. For people who are making long-term investment decisions, I must say I'm not a fan. If you buy, a share that it's very possible that if you're going to buy a share for the next decade, I almost guarantee you it's going to lose 10% at some point in time. And that's not a bad thing. That's part and parcel of volatile markets. So I think for people who are trading or who own things that could double or halve, daily, and especially in the crypto space, then looking at these stop losses might be an idea. For long-term share investors, not something I would advocate, because usually what happens is your stop loss kicks in and you sell the investment 10% down. You're now sitting in cash, and it usually the investment turns at 11% and shoots back up again and gives you capital growth, and you've missed out on that because your stop losses put you in cash, and all the time you've had trading costs with those stop losses. So they are valuable for traders. I'm not convinced they're great for long-term investors.
Warren Ingram from Galileo Capital, author of Global Investing Made Easy. Saturday, sleepless nights between now and then, please, if you wouldn't mind, because I need the upper hand. I think conflict is good at Franschhoek. There's not enough conflict at Franschhoek, so I think we need to create a bit of a stir. But I'm looking forward to the chat coming up on Saturday at 1 o'clock with Warren Ingram.